Before we start, this is general advice in nature. Should you wish to take personal advice, please reach out to your advisor. Welcome to Picture Perspective. My name's Jordan Kennedy. Today, I'm fortunate enough to be joined by Louise Meijer, one of my fellow partners, to talk all things super, one of the topics that I get really excited about. Louise, let's kick off. So Louise, with 30 June just around the corner, what are the things that we should be thinking about with all things contributions coming up?
So with super contributions, 30 June is obviously an important time because some of the caps and limits that we have are sort of use it or lose it. So if you don't make it the contribution by the end of the financial year, you might miss out on an
100%.
opportunity to put money into super. So the first type of contributions that we look at are concessional contributions. These are ones where someone claims a tax deduction for that contribution. So that's whether it's your employer or you personally.
Yep.
So the cap for that contribution is $30,000 per annum.
Mm-hmm.
And you have the opportunity to look at that as a total cap across both of those types of contributions. So if your employer contribution doesn't reach that cap,
Yep.
Or if you have no employer contribution at all, you can make a personal contribution and potentially claim it as a tax deduction. So that can be quite valuable, that tax deduction. Need to look at age limits. So you can do that up to the age of 75. But if you're over 67, you need to pass a work test to be able to make that contribution. Now, those rules and also those limits have changed over the years.
Yep.
So it's worth getting some advice.
Yeah, reaching out and finding out what's changed. Those caps also move around frequently as well. So making sure you're on top of the change, because I've experienced a number of clients that have they thought, it was $27,500 and they're bang on that number, and then only to find out after the financial year ends that it has crept up or has increased.
Yeah, exactly. And if you are trying to combine contributions from a couple of different sources, timing is really important.
Hugely important.
So the contribution needs to effectively be with the super fund by 30 June. You don't want to be playing around on the last day of the financial year because it can really mess up your plans if it goes in on the wrong day. And you are also expected to know exactly what your employer has contributed. So if they happen to make a contribution early or late and it's not what you thought was going to happen, you can end up with a problem with your contribution either being less than you thought it was going to be, you've missed out on an opportunity, or it's more, and then you've got to deal with excess contributions, which is a bit of a nightmare, actually.
And you also have the benefit, it's probably better to be slightly under than slightly over. The unused caps from prior years that you can sometimes dive into if you have, if you want to allow a margin for error, so to speak, in not knowing what your employer is going to do or the timing of your employer contributions.
Yeah, there can be an opportunity to do that. So the other cap we look at is non-concessional contributions. So these are ones where you don't claim a tax deduction for them. So it's really if you want to boost your super balance, you are able to make additional contributions to super. And you can do this if your total super balance is under $1.9 million currently. That limit's going up to $2 million next financial year. And there is an annual cap on this of $120,000 per annum. You might have the opportunity to do 3 years worth of contributions over a 3-year period where you can work out the timing that suits you. If you're going to do that, you need to be under 75, but also you really need to be careful doing this because you don't want to exceed your caps because the consequences, particularly for those non-concessional contributions, are quite severe. Mm-hmm. So you definitely need to get advice. And when I say advice, whenever we talk about super, we're usually talking about a financial advisor and an accountant, ideally working together.
Yeah,
exactly.
Concessional contributions, what's the tax effect on those?
As I mentioned, you could claim a personal tax deduction for those contributions if you meet the criteria. The super fund will pay a 15% tax on that contribution. Mm-hmm. So ideally you've got your deduction at a higher marginal tax rate and the fund's paying 15%. But there is an additional surcharge called Division 293 tax. if your taxable income exceeds $250,000, some adjustments in there, but there's an additional 15% tax levied, which you could pay personally or the fund could pay it. But it brings that total tax rate on that contribution to 30%. So it's just something to look out for.
So Louise, are there any contribution strategies that our audience might not be aware of, not the traditional ones that we should walk them through?
Yeah, so one that can come in handy sometimes is that a contribution can be made obviously by transferring cash into your super fund, but it can also be made by transferring an asset into the fund. So obviously this is more of a self-managed super fund strategy. Yep. There are restrictions on what type of assets you're allowed to do that with. So listed shares, widely held trust units, interest in business real property are the main examples. But this can be quite handy if you have an investment in your own name that you'd like to move into your self-managed fund.
You want to retain the exposure to something, you still like the asset, but you want to move it from the right hand to the left hand.
Yeah.
Awesome.
But you could still get a tax deduction for that contribution. You do need to make sure that you're aware of the capital gains tax exposure in your own name when you've moved the asset.
That's a good one.
But it's something to keep in mind. Another one is the opportunity where you can carry forward prior year unused concessional contribution caps.
It's a mouthful.
It is. It's quite a fiddly strategy, but it's been available for a few years now. It's if your total super balance, so that's the balance in all your funds put together, is less than $500,000 at 30 June last year, so 2024 in this case. You have the opportunity, and you haven't used your contribution caps for the last 5 years.
Or you haven't fully used those caps over the last 5 years.
Yeah, so even if you've partially used them, you've had some employer contributions, for example, but you've left some space there, you have the opportunity to make an additional contribution this year to make up for that shortfall. So sometimes you can time it with a family trust distribution or a dividend or something like that, just to make the most of the tax opportunity. But it's you really need to be careful again, and your super fund and or the online services from the tax office will tell you exactly what your available cap is.
The MyGov app or website really gives you a nice little table that really spells it out. You do have to be aware of when that data gets updated, because obviously they refresh that information. So you just got to be aware of the currency, mainly of the current year, of the unused cap before deploying that strategy. So Louise, running a self-managed super fund, what are the specific things we need to be aware of coming into the year end?
Yeah, so one thing to be looking at is if you're paying a pension out of the super fund, that you need to make sure you've met your minimum payment requirements. And that minimum is based on the balance of the fund's value at the end of the prior financial year, and a percentage which is dependent on your age. So if you've jumped into a different age bracket, your percentage
you've got to pay out more.
That's right. So the consequences of not paying your minimum pension are quite severe. You lose the tax benefit of that pension exemption within the fund.
Yep.
So you really want to get that right and pay at least the minimum. So it's definitely worth at this time of year to just double check you know what the limit is, the minimum is, and that you've paid it or you're going to be able to pay it. Again, by 30 June, it's a hard and fast date.
Cash needs to come out of the fund before the 30th of June. Yep.
Yeah. And one final thing that's always an end of financial year planning exercise around tax is capital gains tax. So if you've realised a big capital gain in your fund during the year, it's worth looking at, are there any capital losses around that may be able to offset it? But do keep in mind the tax rate in a super fund is relatively low on capital gains. So it's 15% or 10% on discount.
If you've held for more than 12 months,
And if you're paying a pension, it might be nil. So you don't need to do anything rash necessarily if you've got a capital gain in your super fund. It's just worth having a look at what what the outcome would be, work with your accountant and your financial advisor and decide whether you need to take any action.
Oh, thanks, Louise. Really interesting conversation. Really appreciate your insights on super. If anybody has any questions specifically to some of the technical things that we ran through today, please reach out. We look forward to assisting you further.